The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Europe. I'm Steve Sedgwick with Juliana Tattlebaum, and these are your headlines. Well, June's inflation print is crossing the wires. Another key data point for UK Chancellor Rachel Reeves as she uses her Mansion House speech to call on regulators to do more to boost growth.
In too many areas, regulation still acts as a boot on the neck of businesses, choking off the enterprise and innovation that is the lifeblood of economic growth.
Meanwhile, US inflation ticks a bit higher in June as tariffs just about begin to eat into that core CPI figure. President Trump responding to the figures by continuing, yes, you guessed it, to ramp up his criticism of the Fed. We're going to dig into the US outlook with the excellent ADP chief economist Neela Richardson. That's coming up in a few moments' time.
Meantime, French Prime Minister Francois Bayrou incurs the wrath of the far right as he calls for budget cuts of 44 billion euros, while also potentially scrapping 2 public holidays. And Renault slashes its full-year guidance, citing weak demand in Europe and growing competition from China, as the French carmaker installs finance chief Duncan Minto as interim CEO. A very warm welcome to Squawk Box Europe. We're going to kick off the show with some fresh data out of the UK. We've got a fresh inflation reading for the month of June, and the CPI for the UK coming in higher than the market expected. 3.6% is the year-on-year figure. Economists had been expecting a 3.4% print. In terms of core CPI, which excludes energy, food, alcohol, tobacco, 3.7% year-on-year is the figure. That was also higher than the expectation of 3.5%. So inflation accelerating here in the UK. In terms of the detail and the context here, inflation has risen steadily since hitting a 3-year low of 1.7% last September. The Bank of England had previously said it expects inflation to peak around 3.7% between July and September before dropping back to its 2% target. So interesting here, I think, that in the UK, the inflation picture seems to be getting a little bit more intense at 3.6% versus 3.4% expected. So approaching where the Bank of England saw it peaking this year.
Yeah, it's not great for the Bank of England's hopes of cutting rates sooner rather than later. It is not great news for the Chancellor, who, of course, one of the biggest borrowers in the United Kingdom is the United Kingdom government, and they will have a higher cost of financing because if interest rates remain higher for longer, which means Rachel Reeves, despite her feel-good chat to the city and the great and the good at the Mansion House yesterday, and we discussed that with the Lord Mayor, who sat next to her last night, I'm afraid to say it is bad news for the government, bad news for people who want lower interest rates. Interesting to see, as we can see on the screen there, the pound rallying harder on the premise, which I think is probably right, that rates will remain higher for longer.
Good news for holders of the pound this morning. That's the main winner, I'd say, at this stage.
Yeah, I mean, look, those of us who may well be travelling abroad to various climes on both sides of the Atlantic over the next couple of weeks or a couple of months, it is possibly good news, yes. You travelling at all?
I am in August. Let's see if these gains hold.
Where are you going in August?
Europe. We're going to the continent, so
lovely.
We'll see.
I'll see you there. I think Karen will still be there, so we'll all see each other. US consumer prices, meanwhile, rose 2.7% on the year in June amid signs President Trump's tariffs are just beginning to be felt. Now, while in line with expectations, June's reading was well above the Federal Reserve's target of 2%. Of course, economists warning the full impact of Trump's trade agenda could raise consumer prices further. Now, attention turning to today's PPI print with expectations of a 0.2% rise on the month. Yesterday's inflation print saw traders stick to their September rate cut bets, with just over 52% expecting a 25 basis point cut, according to the CME's Fed Watch tool. Almost 97% of traders expect the Fed to hold rates at this month's meeting. Meanwhile, the market, very mixed performance when you look at the Dow versus the Nasdaq.
Yeah, there was a mixed performance. We saw the Nasdaq continuing to climb higher, more positive momentum there. The Nasdaq gaining about 18 basis points over the course of the day. The Dow Jones, meanwhile, retreated about 1%, and the S&P 500 pulled back about 0.4%. A lot of banks in focus from an earnings perspective, and of course the CPI print yesterday. Now investor attention on the macro front turning to the PPI print due out today. We'll get some insight into how various parts of the supply chain are being impacted by tariffs. In terms of U.S. futures, here's the indication, the early look at how Wall Street's poised to open. We're looking at a pretty muted pullback this morning. So the Dow Jones looking to lose about 100 points at this point. The Nasdaq, which outperformed yesterday, also looking to slip a little bit at the open if these levels hold.
Right, JP Morgan CEO Jamie Dimon has warned the central bank's independence is critical, adding that playing around with the Fed can have adverse consequences. His caution comes as the Trump administration continues to hit out at the chair Jerome Powell, claiming he has not lowered rates quickly enough. Whilst the Treasury Secretary Scott Bessent said a process to find Powell's replacement is now underway. Well, you'd expect that anyway. I mean, he's due out May, so that's logical. Anyway, Powell's term as Fed chair, as I mentioned, ends in May next year. Now, Neela Richardson is chief economist at ADP, and it's always a highlight of this show when Neela joins us as well. Yeah. No, it is Neela. I know. I shouldn't have my favourites in the economist world, but, you know...
Thank you. It's great to be here.
A bit like your children, really. You know, me and economists, you know, you shouldn't have your favourites, but you do. I hope none of my kids are watching. No, they're not. It's too early. Right, good morning to you. Lovely to see you, as ever. Why don't we start off with the inflation prints as well? If I was only looking at toy prices, I would be concerned. They registered a 1.8% increase in monthly consecutive growth. Household furnishings up by 1%. That's the bad news. The good news is a lot of lodging and other things are under control. There is nothing terrifying in this data. I know people are desperate to find something tariff related, and I think I found it in toys and household goods. But by and large, there is nothing particularly frightening in these numbers, is there?
Well, it's not really the speed in which inflation is rising, it's more the direction. Yes. And there is a hint that in goods, we're seeing a turn in direction, not the speed. And I grant you, though, I know for a fact that you are a tea drinker and you didn't mention the high coffee prices.
That's true.
I'm an American coffee is a really big, that's the down point for me in this report. But we saw actually some declines in shelter prices. Economists have been waiting for that decline in momentum for a very long time, but it's being drowned out right now because there is a concern not about June, but future months, and there are hints within this report of where inflation could rise again in that core goods sector, which had been performing so well post-pandemic in terms of lowering inflation.
Yeah, so look, the wait and see, if I take out all the politics and I take out all the noise, which is what most members of the Federal Reserve try and do. I mean, some of them may well be jostling for a future job that may or may not come up. So maybe they've got a different eye on the prize. But for most members of the Federal Reserve, I trust that they are only looking at the data because that is what they've said they are doing. Right. There is no reason to move interest rates on the basis of this CPI print, is there?
There is not. If you take the CPI print and you match that with the labor market, where we saw in the U.S. the unemployment rate dip down from 4.2% to 4.1%, there's not a big calling coming from these numbers. But if you project out, and that's what the Fed does, they're looking at higher inflation and slower growth. And so there is also a reason to be cautious about the future direction of travel for the whole U.S. economy. If you might expect a consumer to feel the burden of these inflation ongoing and to see a slump in spending. And we'll get retail sales numbers as well this week in the U.S., and that'll give us a sense of how the consumer is holding up.
Neela, I'm just going to ask one more, and Juliana will allow me to do this. I know, because we've had brilliant conversations previously, that you think there is a variance between the Bureau of Labour Statistics data and what they're seeing and what the ADP is seeing as well. And there have been times when that variance has been large and other times when it's coalesced as well. What are you seeing over at the ADP in the private sector as well? Anything that differs from what the Bureau of Labour Statistics is finding?
The overall trend is actually the same.
Yeah.
We are seeing a hiring hesitancy and a reluctance to replace among employers. in the United States, the initial jobless claims, which is a proxy for layoffs, I think you call it redundancies here, they're at near historical lows, but we're not seeing a lot of dynamism. We're not seeing a lot of hiring. We're not seeing the things that make up a healthy labor market. And in fact, if you're looking for a real big point-to-point difference between the BLS and the ADP, look at healthcare, because healthcare is driving most of the job gains in that BLS report. Healthcare, education, and leisure and hospitality. It's a highly concentrated gain for the BLS. But overall, both series are seeing a slowdown in momentum, a concentration in industry hiring, and that's concerning because you want growth to be broad-based. Now, what's interesting here, though, is we're not seeing a huge drop in manufacturing. Actually, in both series, manufacturing is not really showing any evidence that tariffs are biting in terms of hiring. That could be some pull forward hiring to get around policies, but that's a wait and see number that we're both looking at.
In terms of the labor market data, where are we likely to see the first cracks emerge? It sounds like clearly the momentum is slowing, but if we are going to look for early signs of a major tariff impact here, where will that show up?
You know, that's such an interesting question because you would expect it to be in manufacturing or maybe in warehousing, for example. You're not seeing that there because I think companies did pull in ahead inventories and they did stock their shelves and to get in advance. But we are seeing significant declines in professional business services and B2B services. I think that's linked not to necessarily the policy, but the uncertainty which bites across sectors, whether you're a manufacturer or not.
We have seen the Trump administration crack down on immigration alongside all of his measures around trade and tariffs. Are you seeing that come through in terms of impact on the labor market at this stage?
You know, I think that's going to be a persistent part of the supply story. Labor force participation rates are now a percentage point lower than they were before the pandemic, and there are key pockets of the U.S. economy. Construction workers, for example, the care economy, social assistance, healthcare, that relies on immigrant labor, agriculture. So those pockets are going to start showing some strain unless workers are able to be replaced. And that's where I would look at that.
I know you're not going to stray into politics, and I know you and your team will rehearse vehemently what you're going to say when I ask this question, but I'm going to ask it anyway as well. Are you concerned about Fed independence and political interference in the process to pick the next chair of the Fed?
You know, I look at it this way. It's okay for a football fan to scream from the sidelines as long as they don't go onto the field. And it is not unusual for a president to weigh in on their opinion. But when we cross the line into Fed independence, that has bigger ramifications than the actual move itself. It impacts the credibility of the institution. And we talk a lot about the Federal Reserve, but they only have one currency. It's not interest rates, it's credibility. And that has to be pristine through this process for markets to believe that they are doing their job and ultimately driving down inflation and supporting the labor
Hardy
market.
always had Stan Laurel as his fall guy. He always had his scapegoat to blame him as another fine mess you've got us into. This is a cultural reference in America before the year 2000, by the way. You won't understand it. But he always, no, she doesn't. She knows nothing about American cultural history before this century.
Before 1950.
Okay, well, you definitely won't know what I'm talking about anyway. But I mean, there was Laurel always had Hardy, or Hardy always had Laurel, whichever way you want to look at it. But he needs a scapegoat, because if you get rid of the scapegoat, you know, who are you going to beat up on? So despite all the noise that the president is making, the fan screaming at the edge, or maybe just putting his head on his toe over the football field, he needs Powell, doesn't he, as a scapegoat?
Well, I think America and the world needs an independent Fed. And that is a fact. Yeah. So in order to keep this huge U.S. Treasury market operational and everything that goes along with it, as the U.S. as the reserve currency, it requires an institution that has the gravitas to make policy decisions that not only affect the United States, but affect the world.
You used a sports analogy, and so did Scott Besson yesterday. I don't know if you heard him, but he was doing an interview with our with another network yesterday, and characterizing Trump's criticism of the Fed as simply working the refs, saying that that's what you see in sports all the time. That's all he's doing. It's not actual interference. He's just working the refs.
I only watch sports for the analogies, honestly.
If you're a franchise owner and you're working the, I don't know what the analogy is.
If you're, yeah, that's a fair point. If you're a franchise owner, do you have the same kind of, is there a conflict of interest if you're working the refs the same way a fan is?
I don't know. If you're an NBA official or whatever, or an NFL official. And
the commissioner working the refs.
Yeah, I don't know.
That's probably a nuance to the analogy. Let me switch gears here while we have you, given your expertise in terms of what's going on in the labor market, and ask about AI. Mm-hmm. Are you seeing major disruption at this point? And if so, where? Just give us some color.
No, not major disruption. Okay. We're not seeing major disruption. But yes, on the edges, you're seeing more companies report AI in terms of talent management and try to demonstrate actually the value of artificial intelligence in making them more efficient or more productive. But when it comes to the worker, we're spending a lot of time at ADP breaking down a job and talking about tasks and skills. Because ultimately, what any productivity boom cycle requires is worker transitions. And we know it's coming. Our jobs are going to change. So how do we help the workforce make that transition into jobs that are not only sustainable, but higher paying? And I think that is something you can actually use AI to accomplish.
I still don't get it. No one I'm really excited about AI myself. But I don't understand what those jobs are going to be, because everyone keeps saying, oh, you're going to need AI experts. But you're not, because the AI will be the expert. I still don't get it. I don't know. Any thoughts, Nina?
Probably to a point.
You know way more about this than I ever will know.
I think it broadens the box. So we operate in a box of what we think we can accomplish. What Gen AI promises, and AI has been around since the 1950s, so you have a cultural reference there. But what these new technologies and platforms allow for is for us to reimagine and reinvent our own jobs. So it's not about what you can do today, but it's what you could possibly do tomorrow. And that's what's exciting.
I thought I was on safe ground with her, with Lauren Hardy. You heard of Lauren Hardy? Yeah?
I have heard of them.
What about if I went Buster Keaton, Harold Lloyd?
No. What if I went Taylor Swift?
I love Taylor Swift.
Okay, that was a little bit too. That was a little too mainstream.
What if I hit you with Gracie Abrams, Olivia Rodrigo, Sabrina Carpenter? Back at you.
Ashley Simpson. All right. Okay. That's not that fun.
Okay. Let's go there. We'll do this off air. Nina, lovely to see you.
Great.
Thank you very much indeed. I don't know if you're a Swiftie fan. Are you a Swiftie fan?
Of course. We're all Swiftie fans at heart.
Nina Richardson, Chief Economist at ADP, and of course a secret, not so secret, Swiftie fan. Thank you. Lovely to see you.
Not so secret anymore. Coming up on the program, UK Chancellor Rachel Reeves announces a sweeping package of reforms to the financial services sector. We'll take a closer look next. Plus, earnings season continues with the latest numbers out of ASML and Richemont. We'll break those down later this hour. And later on the show, we'll be joined by the CEO of SEB as the lender reports its second quarter results. Don't miss that conversation at 9:15 PST. Welcome back to the program. Let's get a check on European futures. We are about 40 minutes away from the market open this morning, and we're looking at a bit of a pullback here in lockstep with the pullback indicated by U.S. futures. Nothing major in terms of the magnitude, but the DAX looking to drop about 0.6% at this point, leading the losses across the region. A lot of focus on France this week from a political perspective, with French far-right leader Marine Le Pen threatening to bring down the government unless Prime Minister Francois Bayrou scraps his proposed budget plans. Bayrou has unveiled a package of 44 billion euros in tax rises and spending cuts, which also includes a plan to cut back on 2 national holidays in order to boost economic activity. The French Prime Minister warned the country was facing a moment of truth, arguing it could spiral into a debt crisis if no steps were taken. Le Pen has criticized the plan, calling it an attack on French people. French lawmakers will debate the proposals when Parliament returns after the summer break. Back here in the UK, headline consumer prices across the country came in hotter than expected in June, rising 3.6% on the year, driven by higher transport costs. Core inflation also topped forecasts, rising 3.7%. UK Chancellor Rachel Reeves used her Mansion House speech to announce what she called the most wide-ranging package of reforms to the financial services sector in more than a decade, while reaffirming her commitment to stability as pressure mounts to find spending cuts or have to raise taxes in the autumn's budget. Our very own Ritika is out in front of Westminster this morning. She's been tracking everything the Chancellor has had to say in the last 24 hours. Ritika, talk us through what was announced in the Mansion House speech last night and how investors, the investment community, has reacted.
Well, first of all, Rachel Reeves was calling for more risk in the financial services sector to boost growth. And this is as she tries to rebuild her relationship with the city. This is after that recent market turmoil that we saw just a few weeks ago after she was seen crying in the House of Commons. So she wants to provide an image of stability here, that she's not going anywhere. And she said she is proud to be the Chancellor. She also reiterated her commitment to her fiscal rules. Take a listen.
It was this government, that restored Britain's reputation as a beacon of stability by putting the public finances back on a firm footing, getting debt on a downward path, while investing prudently alongside business. That was, and still is, the right choice. National debt remains at its highest level since the 1960s, and globally the cost of borrowing has increased in recent years. Now, it's not the inheritance that I would have chosen, but it is the reality. And that is why the Prime Minister and I and this government remain committed to our non-negotiable fiscal rules.
And she announced a host of different changes, especially when it comes to cutting the red tape to get the city to buy into the growth story. And that leads me on to some of those changes, some of which I'll highlight: easing access to mortgages to spur home growth, incentives to get people to invest in the UK. That includes a concierge service for international investors who want to get into the UK market, lower capital requirements for banks, a reform of the UK ring fencing, and making it easier for banks to hire. The Chancellor claimed that this is the biggest overhaul of regulation in a decade.
In too many areas, regulation still acts as a boot on the neck of businesses, choking off the enterprise and innovation that is the lifeblood of economic growth. Regulators in other sectors must take up the call that I make this evening, not to bend to the temptation of excessive caution, but to boldly regulate for growth, in the service of prosperity for our whole country.
But it's also important to focus on what wasn't mentioned. Crucially, she dodged quite a controversial question about taxes. There is a lot of growing concern that the Chancellor is going to face a black hole, could be 20 to 30 billion pounds, and that she's going to have to plug that, and it looks like tax hikes could be the only way, and that really was the big elephant in the room that just wasn't addressed. Steve, Juliana.
Ritika, let me pick you up. You said a couple of really interesting things, and I don't have a lot of. I'm curious. I'm curious, a better way to say it, as to what they actually mean. A concierge service to try to make it easier for investors who want to invest in the UK, and making it easier for banks to hire. I mean, so far, this government has only made it more difficult for certainly wealthy individuals to want to stay in this country, with changes to non-dom and also considerations to lengthen the process to getting indefinite leave to remain. So what exactly do those measures look like? How does she plan to make it easier for banks to hire? What does this concierge service actually look like?
Well, the concierge service, that's for international investors, as I mentioned, is to make the process easier. So when it comes to visas, when it comes to advising about regulation, that's the kind of areas that she's focusing on with that. And with making it easier for banks to hire, she's trying to get rid of some lengthy delays that they've had in kind of processing. So some of those administration areas that she wants to get rid of, that many in the industry have complained about. So that should help a lot of people in the city.
Superb work, and do say hello to Steve Bray for me. You're doing very well with this distraction of the the pro-EU mob behind it. I mean, Steve's obviously a regular fixture on this show for the last 9 years now. I've had my run-ins, but he's basically a decent person. Anyway, he's the guy in the hat behind you anyway. But well done for working amidst that as well. Do you know Steve Bray?
I recognize him from your OBs. I don't know personally.
Well, we've had an up and down relationship. I was actually really dumb. Viewers won't be surprised. Last time I was on Abingdon Green, and I know Steve.
Oh, I remember this.
And I was like, "Can you?" And I said, "You made your point. Can you move on now?" And he's like, he was about to go. Then I said something else. And I can't remember what it was. It was something provocative and inflammatory. And then he came back and stood there again.
During your interview, I think. Yeah, you took the bait, Steve. That's what he wants.
Know,
it's pretty effective.
No, but I don't have a problem. I'm a great fan of legal protest.
Yeah, it's pretty effective.
It's a part of democracy, you know.
Yeah.
But he always chances on because actually the police move him on from Abingdon Green a little bit later on anyway. But yeah, there you go. That's all part of the rich pageantry of democracy. I've been doing loads of work, by the way, on average holidays in the UK compared with France.
Oh, I'm so curious.
Well,
I'm curious what Charlotte has to say about it, too.
Charlotte will be joining us in a while. Britain's retailers will be closely watching the Chancellor's budget this autumn, won't we all? With some feeling the pinch from the government's tax changes, won't we all? For more on the high street and the UK high street, check out Ian King's CNBC UK Exchange newsletter.